back on Morning Movers. I'm Diane King Hall, live from the floor of the New York Stock Exchange. Joining me now to discuss the state of gold, precious metals, oil, and beyond, we've got Phil Streible, Chief Market Strategist, Blue Line Futures. All right, Phil, it is good to see you here at the big board.
Yeah, thanks for having me on.
So let's jump into this with gold. So I'm checking gold right now. It's up 1.25% above $4,200 an ounce. I mean, it's been on this record-breaking run, and it seems unstoppable, the performance this year. What's your take on this?
Yeah, it's up over 50% this year. We've seen the ETF flows, and it's really the diversification that's been coming into the market. It's up about 17% year to date. So that market cap on gold is about $450 billion. It's the widespread adoption from individual investors on top of central bank demand. Really since 2022, with Russia increasing their reserves on the gold market, we're seeing other central banks in focus. So China keeps buying any kind of dip, and currently they got about 8% in gold holdings in their reserves, and it looks like they want to get to about 20%.
Kind of dip. I'm like, when is the dip coming in gold?
It's been tough. Yeah. The volatility in it, it's about $90 a day. So we're seeing these ranges up and down. Remember, volatility goes both ways. It's not only down, but it's also up. So it is possible that we see, perhaps once economic data starts getting released, maybe some higher inflation data, maybe strengthening in the jobs market, you'll see gold prices back off.
Okay, and let me ask you this. There's been talk of gold heading to 5,000. When do you see that happening?
Citi upped it to like 10,000 today. I
missed that one. Oh my gosh.
I know. So if we're moving $90 a day and we're at 4,200, we could be there in 2 weeks. You know, so it's tough when you anchor on these, these round price targets here. And what do a lot of investors do when it hits these price targets? How do they position themselves? We saw a lot of people take silver off at 50. Now it's at $52. So, it's tough when you have these price targets, and there are oftentimes overshoots on those.
Okay, I'm glad you brought up silver because I want to ask about that, and it's been on a tear percentage-wise, a greater increase or run-up that you've seen this year. Is that because of, it's just momentum on the side of precious metals right now?
It has helped it quite a bit. Silver's up over 70%. That market cap's only about $50 billion, so it's 9 times smaller than the gold market, and that's where you get the higher volatility in play. Silver has many different demands here, and it is a momentum chaser. It's trading almost like a meme stock, like Bitcoin and things like that. So a lot of people asking, is it frothy?
Yes.
That froth up there is where these people are coming in and they just want to make a quick buck in that market. It's really when they start to leave the market is when the market will start to consolidate. But silver's got 54% industrial demand, much of the demand's from EV, electrification. Solar, when you get too high on prices of silver, you'll start to see solar manufacturers substitute with copper, aluminum, things like that. So it unfortunately, it does have this diminishing return once it goes so high, the demand structural change.
I want to go back to gold, that 10,000 price target that you mentioned from Citi today, or even the 5,000. What are the forces that get it there? It's
going to be the widespread adoption. With the traditional portfolio, the 60-40 portfolio is essentially dead. What people realize is that you have to incorporate small slices or slivers of different commodities and different asset classes into your portfolio, and you'll do much better having small bits of Bitcoin, gold, silver, copper, crude oil. Commodities are really an essential role in everything in everyone's portfolio in our day-to-day life.
You know how they call Bitcoin essentially digital gold now, and you just talked earlier about the volatility of gold. Is the way gold performing this year a little bit closer to how Bitcoin is now performing?
It's definitely taken off quite a bit. The normal range on gold we would see is about $40 a day at the start of the year, and that is essentially doubled. And it's because of the fact that you've got a lot of uncertainty. You've got it's almost neck breaking, some of the Truth Social tweets and things like that. So these tariff headlines are really driving emotions, and that emotion fuels volatility, and that's where the price action.
Does the government shutdown factor into any of the price action when you think about the metals?
Yeah, it's pulled the metals up because you don't have the economic data that could challenge the 25 basis point or even 50 basis points of interest rate cuts ahead. All of a sudden, like I said, if we start getting stronger labor market, we see an uptick in inflation, things like that, you'll see the dynamics of traditional portfolios change a bit, and it could reduce some of the gold holdings.
Yeah, because it's interesting that you mentioned like data blackout, because even if we continue with the government shutdown through next week, we will at least get CPI because they're kind of forcing that to roll out, so there will be a read on that, and could there be then potentially a reaction to that?
Yeah, 100%. Now, the problem with inflation going forward is that you look at energy prices, crude oil just collapsing, agricultural products are coming down. A lot of those key drivers of inflation are starting to come down. So, and that can act as a tailwind where we're seeing robust growth, and this is where you get U.S. equities going up in gold in conjunction.
I'm glad you brought up crude oil, because I know they just brought up a chart. And so crude oil is a little bit higher right now, but I mean, it's below $60 a barrel. So, there was this expectation, as I talked to different experts this year, that you wouldn't see crude oil get past 65 a barrel. What's your thought on that?
Yeah, we stayed within a $5 range, $60 to $65 for about 2 months. We had the most craziest geopolitical event occur, and oil prices couldn't get much over 80, and they collapsed from that. So a lot of those geopolitical risks are coming out. It seems like much of the production is continuing to grow and expand. We're seeing some of the demand is being replaced by EV and things like that. So oil prices are really just comfortable between this 55 on up to about $65. I think maybe a downshoot to 52 is quite possible. And Saudi Arabia is really looking to replace Russia as the key exporter to China.
So last year, I want to go back to where we started this conversation with gold, because I've been fascinated by the run-up that it's had this year. Last year, it was essentially the percentage move was about the same as the S&P 500, right? It was a more than 20% move, 24, 25%, something like that last year. This year, we're up 50%, right? I don't know how that could continue in 2026. What are the risks to the rally that we've been watching?
It's really just the dynamic changes where we start to see that rising inflation. We see central banks, perhaps instead of incorporating gold, they start to look at other alternative assets like having a digital currency, increasing their reserves there. Perhaps some confidence back in the U.S. market where they start to buy treasuries again over gold. That's where you could start to see just those trend changes occur. But it really looks like this market, a lot of people are trying to call tops on it.
Yes.
The reality is you have to wait for the market to complete its high, start to break down, signal a lower high on the charts, and then break that level of support. So you really want to use the technicals to front run any kind of changes in the economy or the dynamics of the market.
Okay, great conversation as usual. Thank you, Phil.
Thank you so much for having me.
Appreciate it. That's Phil Streible, Chief Market Strategist of Blue Line Futures, joining us here at the NYSE. Coming up, we've got